The super rich do not pay any taxes. I'm sure you heard this before. Warren Buffett, Jeff Bezos, Michael Bloomberg, Elon Musk, and countless others pay as little as 0 to 3% of their total income in taxes, whereas the rest of the world pays anywhere from 10 to 37% of their total income in taxes.
If you take the 400 largest incomes in the United States, 131 of those 400 paid tax rates that were below 15%.
So how is this possible? And can you use the same strategies to reduce your own taxes? Well, the answer is yes. There is only one set of tax rules, the Internal Revenue Code. Most people don't understand it, but when you do, you can use it to cut down on your largest expense, taxes.
He didn't pay any federal income tax. So
that makes
if
me
he's
smart.
paid
The tax law has a ton of incentives that anyone can take advantage of. Most people are just unaware of them and end up paying for it when they file their tax return. But that changes right now. I am going to break down the top tax strategies used by the super rich in the most simple and easiest to understand way. And all you have to do is hit that like button below and stick around until the end of this episode. My name is Sherman the CPA, and I tax plan for high income business owners every single day at mycpacoach.com. It's not uncommon for my clients to tell me that they want to pay no taxes like Donald Trump, and my response is in this video, so let's get right into it. All right, so first of all, our tax system is completely based on income. The more income you report on your tax return, the more taxes you will pay. Simple enough, right? Well then, how is it that billionaires pay no taxes then? Well, here is the simple answer. They reduce their taxable income down to almost nothing. You see, there is income and then there is taxable income. You can earn income, but that does not mean that that income is taxable to you, and you only pay tax on your taxable income. So that's the first key here. You want to reduce your taxable income by as much as possible. That's what the super rich do. But how exactly is that done? First, you have to understand what taxable income actually consists of. Now, my definition of taxable income is your total income after all tax losses and tax deductions. The rich report as little income as possible and then wipe out their income with big losses and deductions to avoid paying taxes. The more you understand these three things, income, losses, and deductions, the more you will understand how the rich avoid paying taxes and how you can as well. So let's unpack this a little bit more. Number one, how the rich report less income on their tax returns. The first step to avoid paying taxes is to get as much income out of your name as possible. And there are a lot of ways that the super rich accomplishes this. One way is to pay yourself $1 in W-2 wages like Mark Zuckerberg did one year. Now, of course, he owns Facebook, but Facebook is a completely separate entity from his personal tax return. But here is the greater lesson in this example. Income that is not tied to your name is income that may not be taxed to you on your personal tax return. And the super rich are very clever about what they choose to put their name on. They typically care less about what they personally own and care more about what they actually control in the real world. They strategically set up separate entities that file tax returns separate from themselves to avoid paying taxes. For example, C corporations, trusts, and nonprofits are separate entities that file their own tax returns. And those entities in turn have different tax rules, which may allow them to pay less taxes at the entity level. And I'm willing to bet you that the rich people you often hear about paying no taxes at all are often using various corporations, trusts, and nonprofits to shelter their income. And that's step number one to avoid paying taxes, getting as much of your income out of your name as possible. Number two, how the rich use tax losses to avoid paying taxes. Do you really want to know how Donald Trump avoided paying taxes? Maybe it's because he reported more than $1 billion in real estate losses on his tax returns from 1985 to 1994. And those losses were used to reduce his taxable income down to the point where he owed no income taxes at all. And this is very common with real estate. Now, incurring losses to reduce your taxes may sound counterintuitive to most people. No one wants to lose money to reduce their tax bill. Doesn't make sense to spend $1 to save 25 cents. But that is not what is going on here, especially with real estate. With real estate, you can earn income and still show a tax loss. Here is how. In the same article, it mentions something called depreciation, which was where a big portion of Trump's real estate losses came from. Depreciation single-handedly allowed Trump to reduce his taxes. With that said, this is what you need to understand about depreciation. Depreciation is a non-cash expense that does not cost you any money out of your pockets, that you can then claim on your tax return as a deduction. And not only does the tax law allow real estate investors to take the depreciation deduction, but they also allow you to accelerate your deduction to take more of it in a given year. Because of this, it is very common for the rich to build real estate portfolios, not only to build wealth, but also to cut down on their tax bill. I have an entire real estate tax playlist on our channel, so make sure you subscribe if you want to learn more about that. But real estate is just one of the type of losses that can be used to offset income on your tax return. There are several other types of investment or business losses that the rich commonly use to offset their taxes. But to keep this video very simple, all you need to know is that the rich uses losses to reduce their taxable income, and you can too if you want to pay less taxes. Number 3, how the rich use tax deductions to avoid taxes. Most people understand that tax deductions reduce their taxable income, but there are levels to this, and the super rich play at the highest level when it comes to tax deductions.
Let me check something out. So I went and did some research on buying a jet. If I buy a jet, that jet's $50 million. In America, I can write off the entire $50 million that month.
If you can prove that there is a business purpose behind a purchase, then you can likely write it off on your tax return and pay less taxes. The tax law allows you to deduct all ordinary and necessary expenses incurred in carrying on any trade or business you operate. Then the rich will take this and buy jets, yachts, luxury vehicles, and so on to write it off as business expenses on their tax returns. Now, of course, if the IRS knocks on their door, they will have to demonstrate that those purchases are in fact related to their business, which I believe they are fully prepared for. But those are very aggressive tax deductions, and there are several less aggressive ways to reduce your taxes with business tax deductions. Here's a very easy one. Reinvesting back into your business. Whether that means more employees, more products, or more advertising, the expenses you incur in the pursuit of business income are typically deductible. Here's another simple one. Deducting things you already pay for. I recorded a whole video about simple deductions that 90% of business owners miss, like their health insurance, the business use of their home, and so much more. So make sure you subscribe and check that video out. But in short, take a look at the things you already pay for and ask yourself, are you deducting it? These are things I help my clients figure out every day at mycpacoach.com. And if you want to work directly with me, consider applying on our website today. Otherwise, thank you for watching this video, and I look forward to seeing you in the next episode.